Kyle and Stefan, how are you guys doing?
Good to see you. Thank you.
Doing well.
So I'm liking this because before the pandemic, only only a third of my interviews were on video, and I did the last one with two people, and it wasn't video, so it was a lot of the talking over, so we'll be able to see each other. And I'm excited to have both you guys on because there's a lot going on in your space, in your guys' background. You guys just publicly went live, and it sounds like you guys are on a tear, and you got a lot of good goals and ambitions. And what I'd love to do for the listeners is unpack your guys' background and why you're doing what you're doing, where the money came from, what's the goal, what's success look like, what does a good business to buy look like, what is, all the stuff. I mean, we could go a lot of different directions, and I think we should just let the conversation flow. So whoever wants to tee up who you guys are, your background, and then volley it off to the next one.
Sure.
I'll let Stefan start because he's got double the background.
Well, thanks, Kyle. So Kyle and I have been working together for a long time, and most recently we and our partners launched Foundry, and Foundry is a brand portfolio company. We're looking for a few dozen great brands to acquire and add to our portfolio. We're looking for brands born online, and Amazon's a big part of that. Which is a little bit of our background. So that's how we come to things. About this time last year, I think there was 5, maybe 7-ish public aggregator companies. So it's crazy to think a year later is like 55, 60.
Is that what there is now?
Oh yeah. Yeah. Depending whose list you look at, it's a little nuts. It's like a McDonald's sign, you can use another Forbes article, billions raised, more billions raised.
Right.
Nuts. Anyway, and so, based on my background, which we'll get to in a minute, I was at Amazon 2003 to 2019. I ended by, last 3 years, I ran the Amazon detail page. So I happen to have a few data points and a few opinions that might be backed up with data on how to optimize for conversion on Amazon or any e-commerce shopping. And then, before that, I'd been in marketplace with Kyle from 2009, right? 2009, marketplace business was only 25% of Amazon overall. So I got to be there and just really ride a wave of the growth of third-party selling at Amazon. Worked a lot on Seller Central, seller tools, and also seller growth, just helping identify what are brands and what makes brands and sellers successful and what can we build to help that. And I worked in ops and supply chain prior to my time in marketplace. That's where I met Kyle. So aggregators were calling saying, hey, would you like to be an advisor? Could we talk about an advisor role? And I met some great people at some of these other companies. But I had a small checklist and was like, well, how are they approaching this? What's their model? Who's the team? What do they consider? Is it a transactional relationship? How do they view the founders? What are they looking for? And it just didn't quite match up. It was close, and I like a lot of aspects of some of the other folks out there. But I'd been talking with Kyle because, I had focused on new growth or seller attributes of sellers who were successful growing on Amazon. Mm-hmm. Kyle had worked on this thing called exclusives. So both of us had spent a lot of time looking at different sellers on Amazon. And we said, we could probably build one. Like, let's go find some capital. And we'll get to that part of the story in a minute. But that's how Kyle and I got here. We found some of our partners who were influential in finding the right capital, because that was one of our questions, and how we structure our portfolio company. So Kyle, if we get a little background, you launched exclusives amongst other things in your highlights and time at Amazon.
And I met Stefan in 2013 when I joined Amazon, and although he had a few years on me, I still think of those as early days of marketplace. And around 2014, I think what was becoming apparent was that there was this revolution of direct to consumer companies. So having been a merchant in my past, where we were essentially the gatekeepers to those customers in our retail stores, there was this wave of consumer brands coming to marketplace that got to bypass those traditional gatekeepers and just take their product and validate it directly with people. And I think there were a lot of things as a marketplace that we needed to develop to continue to facilitate and support those brands as they grew. And I would say my relationship with, Stefan really developed out of that at Amazon, because in a lot of cases, Mike was on the leading edge of figuring out what it was that brands needed. Stefan's team was great at taking that and making it scalable to all sellers. And I think if you things together, a lot of what brand owners have today in terms of advertising parity programs, new programs that have emerged around protecting your brand, presenting your content, a lot of those started early stage with, those kind of conversations, how we did it manually and then how we could automate and scale it. And, during that time, we started a program called Amazon Exclusives, which then became Amazon Launchpad as they kind of focused on more of a marketplace seller business. And really, that just provided a blueprint, as Stefan said, of watching 10,000 brands grow over a time period, 5 and 6 years.
Yeah, I mean, just the sheer volume of data points and success and failure stories that you guys have seen has got to be just, we don't have enough time on this show to unpack it all, but it's obvious that you're putting it to good use with the strategies you guys are now deploying. To lay some groundwork, guys, for just some terminology. I know there's going to be a good chunk of listeners that are very familiar with brands and Amazon and e-commerce, but then there's a chunk that might not be familiar. What is your definition of a brand, and how would that compare to some of the other things that are on Amazon or e-commerce?
I had this question. I was talking with a friend of mine as well, a kind of longtime Amazon guy, and he's doing a lot of work in the brand space. And he had kind of a snarky view. He's like, are we really seeing brand right? Isn't it just a cohesive product line with some extra margin for ads? Right. And I was like, wow, that's a really
cold way of looking at it, right?
Right. Well, we created a trademark, we created a brand name, but I do think you could get cynical, right? We actually, you talk about stories. Well, this question for a couple of years back in the 2013-14 is, how many brands do we have in 3P on Amazon? And there was a fair amount of debate of like, is that really a brand? Right? Do we really, just because someone made up a name, is that a brand? And I think, there's a better way, and it's one we like at Foundry, is we do think that a brand, yes, it should be a cohesive product line. It should be something that has regular releases where you're developing it line. But there should probably be a customer connection, right? The really memorable, powerful brands are the engage is where customer connection, and that might be measurable. Might be able to look at, say, followings in social media or some other thing. But really, we're connecting with our customers, or the brand is connecting and resonating with the customers, particularly over time. And that's the part I think I would look for. We look for a Foundry.
That's super good way to put it, because you're not white labeling a bunch of pens and selling them instead of through the dollar store on Amazon, right? It's interesting because, and this is a small anecdotal story, is I've got a friend and client who they own a company that was in retail, and then they went into and they partnered up with a manufacturer that then they white labeled their own brands. Then they went from retail to manufacturing to then now selling it on Shopify and other places. So and they've got this whole community, and there's people that go to them for knowledge and how things are working in their industry. And they also buy stuff from them. And so I think I'm glad you guys laid that groundwork, because I think it's important as we're talking about what is a brand, and as you guys are aggregating brands, it's not a bunch of people reselling Bic pens on Amazon, right? I think there's actual company in different ways there's something tangible there of value.
Yeah, I think one of the interesting pieces was, and having sat in this meeting and had to lead one of these discussions one time, you can always find an exception to what a brand is. And so, there can be where it's happened, where you feel truly proud that you've narrowed in on a definition of that includes exceptions. There's always, a way to think about it. And I think Stefan's point is, can't be overemphasized enough, which is, it really does come back to that customer connection.
Mm-hmm.
It's less about the products that you sell, and it's more about the cohesion and that connection and the back to the customer, and that two-way street, right? What are you saying the customer doing that speaks to customer? What are those customers saying about you, and how are you building that loyalty?
Yeah, they're actually thinking about you as a company, not as just a buy now button on Amazon. And right. What I find interesting, and I don't know if this is a good segue into the next part of the conversation, is there are a lot of aggregators out there that are just looking for volume and people and data that are selling things with cash flow. And then there are brands, because you could have someone that's essentially day trading in their basement a bunch of products on Amazon, or product arbitrage, or you're building a company that's got intrinsic enterprise value. And I'm assuming the different aggregators have different philosophies on how they want to buy and what they're planning on doing with them. So with that kind of umbrella, I'd love to hear you guys, like, how did you guys decide that it was your time to start your own aggregator, and why, and how does your philosophy compare to others that are out there?
Yeah, where you started on that, we were, and I guess that ties me. Kyle and I were talking about some of these meetings, because the question is, who would be eligible for different things at Amazon, like in brand registry, or who's eligible for lightning deal. And so brand, and it would come is something. So then we should make brand registry. It wasn't just there's this esoteric guys at Amazon, people at Amazon saying, oh, "What is a brand these days?" And change right. It's and it would go back to the customer, because we're like saying, "Hey, the Amazon customer, who should be giving them lightning deals, and who's going to give them this great access and this great service." And as we're talking to different people, yeah, there's definitely different models. It's just transactional. Thank you for your business. Have a great check. Go see you later. Have a great day. But, maybe Kyle and I are subject, and our other partners, Matt and Tom and some of our early employees, during our time in marketplace, we're operators. We've been on the phone like, hey, my inventory stuck in FBA, or my account just got shut down and I got 20 employees at Christmas. Or, our other, one of our other partners, Tom, he's built and exited brands, multiple times. So we have this notion, it's in our name, Foundry. The founder itself is an asset. Their expertise and their learning, it's not easy. And you spent 2+ years building a business on Amazon, or perhaps beyond. You've learned some things. That's an intense.
The scars to show it too, probably.
Oh, right. You know what that pain is. And so while we certainly think it's time for us to take over your business, and some of it is, can we help you get back to what got you started in the first place and what you really like? Because usually as you grow, something's going to overwhelm you in the running of the business, that you're like, wait a second, I set this up to spend more time with my family, and it's getting big. I'm succeeding and I'm getting less time with my family. Or, I really like the inventing of products, but I've got to make sure we're cash flow positive, and I got payroll, and how do we scale? And so we think that there's opportunities there with founders to stay connected and to invest in a relationship. And also, it may not be the right time to sell, right? Some of our expertise is around how can we help you, guide you in the growth of your business? Maybe you're a good fit with us. So while we want to acquire dozens, we want to serve thousands, whether that's with advice, guidance, or services as we start to bring them out and bring them to bear. So
I'm assuming, Stefan, that did you figure, because how you described your philosophy, and I think that was helpful as you guys are thinking about how you treat and view the founder and the business. How did you realize, like, as people are reaching out to you guys to come consult or help them advise, the different aggregators? And again, this is not about knocking different aggregators. I just want to make sure that that's super clear, because it's the same thing with private equity. I've had so many private equity firms on this show. One was the conscious capitalist PE firm where no hold period, 1.5 billion he'd raised with no hold period. And then others, it's the grind, and we're on fund 17 and we flip them after 5 years, right? Like, just different philosophies, and there's different right things for different people. But I'm assuming as you were having conversations with aggregators, you're like, okay, that just doesn't align with how I view what should be being done, or what you enjoy. And then how did that translate into your guys' business and how you set it up and raise the money?
I would say, it was less about trying to find a space that wasn't occupied, because I think there's going to be a lot of winners in the space. Like, the business model can be
probably not 55, but multiple winners.
Yeah. Yeah. So there'll be other winners. I think, we wanted to, it was more about, kind of the underlying principle of, look, Stefan and I grew up in a business at Marketplace that we had, very real and very long-term relationships with, the sellers that were transacting on Marketplace. And we viewed that as, an obligation. We got to know their business. And as Stefan said, if something goes haywire on a Friday evening and you're off the clock, you jumped back on, because it was real people, real dollars, and real people's, jobs and their life. And so I think it's more about being passionate about the fact that, look, there's superpowers that everybody has, and focusing on where the founder wants to take the company and enabling them to take that and being shepherds of the brand over a period of time to help it go to new lengths because, of maybe the founder had capital constraints. Maybe they had time constraints. Maybe they started this as a side project and wake up one day and they're the CEO of a, $5 million revenue company. Being able to, as Stefan said, get back to the things that you were passionate about that led you to start the company in the first place is a huge value proposition. And on our side, taking advantage of that superpower, lends ourselves to being able to create this community that drives value for everyone.
So how did you guys take your philosophies that you just described and raise the money and the capital that aligned with that philosophy? Because there's so many times that I've watched either founders raise money from VCs or someone that starts a PE firm raises institutional money, and then they realize after in fund 1 or 2 that, I got a bunch of bosses that have, requirements for distributions and return of the capital, and they're going to tell me kind of indirectly what I should be doing, when I should make my investments and when we should sell. So there's this huge challenge that I think a lot of people, as they're trying to take the capital, align it with their philosophies and the strategic vision of the aggregator or private equity firm. How did you guys go about doing that?
Well, we're really privileged in our partners. We have a couple great partner firms, and we'll share about more, and that'll come out later. But we're really privileged because we interviewed and talked to a lot, and a number of aggregators are doing what you say. It's I lived around Chicago, Al Capone, mob, mafia, No, I'm just kidding. I don't want to throw anybody under the bus.
Hey, a broke pension fund, man. They'll give you some money for some returns.
Yeah, no, but I think, there is certainly both VC, PE, debt capital out there. And there's a lot of folks who've taken the debt capital to try to go big fast, right? But as exactly said, that can be complicated. And there's a balance here of we're all working to transform a portfolio company business model for businesses born online. And that's the fundamental crux. That's going to take a little time. And so patience is because it's also going to take a little infrastructure. We're going to build. It's not just buy and get on the balance sheet. This isn't just an M&A activity. If we want to be a good portfolio brand operating company, we're going to build some analytics capabilities. We're going to build some software. We're going to invest in the talent level of people to be here 3 to 5 years from now and to be a great brand portfolio operating company. So patience and time is one. And then also, I think as we look at the market and all these people jumping in, I don't know if there's going to be enough time to kind of wait out, just grow organically, get 5 acquisitions, grow for the company that we necessarily want to be. So we're also looking for pretty, let's go straight,
at the potential, right?
Straight to the, straight to a big raise right up front, rather than kind of eking out the dilution. And we found a partner, we talked to a few different companies, got feedback on our model, made some adaptations, and we found a great partner that, I think funding wise, we're up at the front of the pack. The crashes happen at the back of the bike race, not as much at the front. And so I like that. Kind of that model.
I like that a
lot. We're going to build for success, build big, be at the front of the pack. And then also because we're funded a little different, we can think about buying a little different. There's some that are fun. We've met some partners and met some other, I call them partners. We've met some other aggregator companies that are doing it different than us. That we're able to talk to them. They're buying very small, sub 1 million, or they're buying very early stage, which is probably not us. But they've got some processes in their team. It works for them. And then there's a lot of activity in that 4 to 10 million range, right? That
are you talking revenue or EBITDA or what's the when you're saying those numbers? Is that what are you referring to?
Yeah, well, I can look at it either way. But Kyle, how would you describe it?
Yeah, it's I think sub $1 million of revenue, and isn't our target. I think we can buy different, but I think ultimately it comes down to we wanted sponsors that saw and we got those. And we wanted capital that matched our business plan, which to Stefan's point is we want the ability to build the right infrastructure to do this long term. Both of us spent a lot of time at Amazon, and there was always a focus on long term thinking. And this to Stefan's point about there is no buy and hold in this. There's buy, continue to grow and build, and then hold, right? And so the cap structure is really important. If you think of some of these other options that you have out there, either you're stopping constantly to kind of reevaluate and re-rate along the way, or you go the debt route where in 2 years, if you have some kind of structure with the founder where they're dependent on a check being available in 2 years because they've got some kind of compensation tied into rolling some type of equity burnout structure, you want to be sure that they're going to be there at the end of 2 years to pay you. And having that equity model and having that capital is very into giving the type of security I think is critical to the founders. I mean, look, they poured their blood, sweat, and tears into building these businesses. The last thing you want to see is in 2 years when they've given everything to it, somebody's left holding the bag. And I think that was a critical part of what we wanted to have.
So mechanically, what did you guys do? And if I'm creeping too much into proprietary business models or something like that, just absolutely, just say it. I'm just curious because did you guys raise a fund? So do you have like a general partnership structure up top and then an actual fund with a timeline, or is it more of like a holding company structure? Because I'm curious, Kyle, like how do you mechanically accomplish what you're saying? Because like I had this guy Brent Beshore who runs Permanent Equity, and he's got a whole and then Sonny Vanderbeck was the other private equity guy so his it's Satori Capital. So Sonny's PE firm, they have like no hold period, mainly equity, and then Brent's is like a cash flow hurdle and how he's getting money back to the investors. Because that's the big question: is like how do you give money back to the sponsors, investors, if there's no time on the calendar where everything's got to be sold by?
I think that, well, so first off, I ask away, because that's a more intelligent way of asking the question. And a lot of people are asking as aggregators, like, what's the liquidity event, right? Where's the money going to show up? And clearly Thrasio, we can all thank Thrasio for kind of bringing light, and I think their model may, will play out whether it has challenges or not, but, they're clearly moving fast and clearly, look, they're going to go for an IPO, right? Probably pretty soon, right? Looks like that's what they think their end game is. So we'll have some litmus tests, but I think it's kind of early to tell which is the right exit model, or what's, if maybe it's a right or wrong, but which is a better or worse exit model. A year ago there were 5 of these. Now there's 55, right? And what I do, I certainly think IPO would be one way to go. But if we're building a brand portfolio company, and now this isn't just a fund of companies that I've bought, but I've bought a brand portfolio company. How fast did I buy well? How fast can I grow them? And am I growing that EBITDA flywheel and that cash flow? So if I've got a portfolio of brands that are throwing off a good cash flow, maybe sell to another private equity company, right? We should be building that EBITDA growth. And back to the earlier thing, hopefully I've also built a set of engaged customers, right? That I'm remarketing to, or that I'm serving with across the brands that we've acquired.
It's interesting too, because like you talk about traditional private equity. I mean, with Blackstone, what they're doing. They're like, I think they're 1 out of every 5 homes in America. They're now the bidder on. So like anything that's got cash flow that they can gobble up, they'll definitely be a contender. But I think it's interesting, again, going back to like the personalities that come with the capital, and then the timelines and how you're aligning that with what you guys want, and then with what the owners want. You're balancing a tightrope with all the different stakeholders, which is an interesting dynamic and is delicate. And so like going on to like when you're thinking about brands, so we talked about the target revenue size, so $1 million and maybe above. Define what a good company and good brand means to you guys and what is not.
Yeah, I think so. Again, getting back to what defines a brand, I think be a little bit subjective to different people at different times. And there's obviously not one tried and true criteria, but I would say one of the simplest questions you can ask yourself is to define just this brand existing in a decade. If so, then the answer is, okay, clearly there's some connection to customers, there's engagement back and forth. There's something here. It's more than just, hey, I found a product and I'm selling a product and I'm satisfying, some niche.
Mhm.
It's, I can see this brand being durable and long lasting for 10 years. And I think that's really where our focus is, because again, as Stefan said, there's capital here that allows us to build this thing the right way for the long haul. And so our business strategy has to also match that, which means, our vision is that these brands are going to be around for a decade, that we're stewards of continuing to grow these brands. And getting back to the founder piece, which I think is so critically important, it also allows us to partner with founders in creative ways that aren't being used today, right? We know we're going to be around. We know that we have this long-term vision together. And so if a founder approaches us and in some way says, hey, here's what I'm aiming for, to a large extent, we can always try and figure out how to accomplish that there so that we're creating these win-win scenarios as opposed to viewing it as a transaction.
What would be an example of something creative that you guys have done, or like an example of how you're aligning the founder with you guys long term?
Well, I think so much of it comes down to timing. As Stefan said earlier, if we define, the time just isn't right for you, maybe one of the things that we hear all the time is, I'm really optimistic about the next 6 months. I'm really optimistic about the next 24 months. I've invested a lot in product development over the last 6 months. And so, maybe my P&L statement doesn't reflect what the upward possibilities are of the brand, but that, think about Amazon. They were investing constantly to continue to grow, right? They weren't focused on quarter to quarter. They were focused on this long-term vision. And I think when we hear those keywords from founders that we talk to, then we try and dive a little deeper and ask the right questions to get to, what would your ideal scenario look like? And if there's a way to accomplish that together around the line interests, that's going to be a more valuable relationship, not just for the founder, but also for us, because as we improve the experience and the founder has a great experience coming through, the long-term value of referrals, the long-term value of, speaking publicly in a positive light, all of those things come through because we invested the extra time, really, truly understand what we could do together and make sure that our interests are aligned over that time period. And so you can think of, when it comes to timing, you can think of things like rolling some equity forward. You can think about earnout structures. You can think about, a million other iterations that align those interests around what specifically they're looking to accomplish.
Yeah, I think that's the super good points on, and that's you touched on it too. That now, like, there's two components of what I was hearing too. You got the, what do they want with the business, like from their emotions, and then mechanically and economically, how you're going to structure the actual price, right? Is it going to be cash up front, earn out, rolled equity, combination, employment contracts, whatever those are, to economically align towards the longer term for you guys. So here's what I find super intriguing about the Amazon space and the e-commerce space. And especially when a couple years ago, when I started hearing about what Thrasio was doing, again, I can kind of play I'm not as submerged into the space as you guys are. So hopefully if I say something naive, I can call I'm not doing this every day. So like when I think about like the traditional Main Street businesses of, a couple million to a couple 100 million in revenue, and then in EBITDA from $1 million to call it 10 or 15 million, it's based on the sustainability, predictability, and transferability of the cash flow, right? How big of a machine have you built of repeatable sales and systems and processes and finance and forecasting? And then you go, okay, now what industry you're in? Oh, you're in distribution or manufacturing, or, again, then they're analyzing it based on the risk of that industry as well. What I was so intrigued with, which was, it kind of reminded me of our exit from the family business, is that if you looked at an Amazon business, because you guys understand the Amazon operations, I don't know how important all the infrastructure stuff is, more than the sales and the predictability of the traffic and orders and the brand. Because you probably have a model of going, okay, this is exactly how much cash we can generate from this purchase. And I don't know like if I'm making any sense here, but how you're valuing the businesses based on your infrastructure versus like, is it the total EBITDA play? Or like, does that make sense? And like how you get the return?
Yeah. Yeah. One of the things that you can see about Amazon, and I'll let Kyle talk a little bit more about this, is yeah, you get to see, you can kind of look at the whole market, right? You can look at search results and say, wow, there's a new competitor, right? It's like a physical store. It's like, oh, hey, somebody new opened up over there.
You literally see it, or you don't.
But you literally see it. It's in search results, right? And so, I think that reflects. I mean, at the end of the day, business is business. There's ROI, there's EBITDA, and so you can take a lot of the same basic business fundamentals, just like sailing. But Amazon is different waters, and so there's a few kind of home considerations to think about. There's some, well, without getting too much into the Amazon part, but so I was
go for it. It's okay. I mean, like,
you can see things, right? You can see, are there, how fast are people? There's a very low barrier to entry. So, people can copy you quickly. You talk about some of the old stories, right? Literally, there's this black cocktail dress. I don't know, it's 2015 or 16, but that was selling really well. And within 18 days, there was over 22 versions. I wouldn't call them knockoffs, copies, etc. Versions of this dress. And I'm just trying to figure out, as a guy who's running the Amazon detail page, like, how do I help customers distinguish between these different dresses, right? Clothing's already difficult. Like, what's the warp and woof of the fabric? How does it feel? Where does the cut fit?
Right.
What's the quality of the stitching? It's already hard to do as it is. But the speed at which those came, because sellers are watching for good sellers are watching for what customers are doing. So, selling on Amazon, as you evaluate the business, you may look at how good are they at what are they managing for customer inputs? What are they managing for customer signals? Are they watching them at all? Right? What's the complexity of the supply chain? Because those are going to have different impacts. I'll stick with sailing for a minute, right? Different sailboat designs for different waters. And even if you sail kind of the general same design, you sail a little differently. So those are, some of the Amazon sticks that you can expect. If you have a hot seller, whether it's Amazon or somebody else, they're gonna come and look at it, right? Somebody's gonna come after you. So, understanding what do you do around that? Brand strength may be one, but how fast you develop your next product, or how fast you listen to customers and give them something slightly different, that makes a difference. So, looking at Amazon specifics or business behaviors that will set you in good stead at Amazon, or that we can add in for you, right? Gets us to think about how do we preserve the ongoing sustainability of cash flow growth. That is the same, right? We're going to make this business more valuable.
Yeah, I mean, it always is going to boil down to cash flow, unless you can sell it to someone else that doesn't care about cash flow, which is kind of a thing these days. Well, we're going to pretend that reality is still going on.
Yeah, the thing you mentioned at the beginning about what's a brand does start to matter too. So, well, Amazon's a great place to build a brand. It's a great place to start. It takes a lot of things off your plate complexity-wise as you start to develop a customer base, or if customers don't shop for your stuff on Amazon today, Shopify or some other build your own D2C site. During COVID, Walmart's obviously gained a lot of customers with Walmart Plus. And so there's something about in the US. Outside the US, Amazon is not the biggest site in an e-commerce site in a number of European countries or other places in the world like Japan. So, we look for good, sound businesses and sound business fundamentals, and we look at some of the fundamentals that we think are going to help you succeed in e-commerce generally. And then we look at some things that are specific on Amazon.
Is there something when you guys look at a business, let's say it's got a good brand, because I'm assuming that's one of the top stipulations for you guys. Like, is there certain things that when you look at a business and you're going, oh my gosh, the potential here is, I don't know if there's themes of what owner operators and original founders tend to miss. And, from my I'll call it the main street, which is, it's a combination of everything, but the owner typically does what they enjoy, whether they're an engineer or a salesperson or a finance person or whatever it might be. And like in the e-commerce space, I mean, everybody, like, they've got to understand the online traffic, and there's certain like barriers to entry from a knowledge and hustle perspective that they have to hit. But is there something when you look at it from like an operation, where you're going, wow, like traditionally people miss these things. And if you do these things and, because of your infrastructure that you've built, that you can make a big difference and move the needle fast?
I think so we look at about 30 different variables when it comes to assessing a business. And again, that'll continue to evolve over time as customer data points change, as customer engagements change, as shopping behaviors change. But right now we look at about 30 different variables, and that really takes care of all the major areas across the business. And so we're less, it could be supply chain, it could be an inventory management, it could be, advertising spend, it could be advertising optimization, it could be content optimization. I think what we're trying to do is say, look, you've got this brand. How are you connecting with customers? And then, again, this comes back to the founder again, spending that time to really, truly, deep dive with the founder, what the opportunities are. Because in a lot of cases, we may even have assumptions on, hey, from the outside in, it looks like this is a missed opportunity. And then you dive a little bit deeper and you find out through engaging with the founder that that's actually been tried and it was adapted to, a specific model. And maybe that's not the biggest lever to pull, and we find something else. But generally speaking, I think everything's on the table. But at the end of the day, a business exists because of its ability to kind of win hearts and minds of customers. And, they're assessing that, you have some truly objective data point, you have some subjectivity in it. And it's really having that engagement with the founder to figure out, where those opportunities still lie to explore. And, sometimes it's, like I said, capital restraints, sometimes it's time constraints. Sometimes, maybe they tried something and got a signal that they didn't like. And, maybe
Or risk tolerance. Risk tolerance have got to be something to do with it.
100% super common. If this is your livelihood, you make decisions a certain way, right? And you're gonna, you may be more conservative by nature because that is your livelihood. And so having kind of that holistic view of, hey, here's the universe of opportunity that you have access to. Here's your current entitlement and what we can project as the future entitlement with, X and Y changes becomes really important.
How many founders actually know what their working capital is? That's a laugh. Yeah, that's right. I mean, especially if they're getting into holding inventory and stuff. I mean, I know there's a lot of different approaches people can take, especially in your guys' space, but like, I mean, that's got to be a big component in where people, they probably know what it feels like. They probably don't know what it specifically is or how to calculate it tied to the growth that they want to have.
Yeah, it's one of those things where, again, as Stefan mentioned earlier, trying to figure out the right time and part of our job is to educate along this process. And, can't tell you how many times we've sat down and actually built a spreadsheet to explain, what working capital is, how it's assessed. It does get a little simpler in a lot of ways for a digital business because you have typically very quick receivables, through most places, or you're processing that payment really quickly. Payables are generally pretty easy to define. The inventory management gets a little bit more complex because you have so many big, even with a non-seasonal business, you still have, if you use Amazon as an example, 3 or 4 main days that, are going to be disproportionately big to the rest. And so your inventory can kind of fluctuate at times to serve this need. But, then there's also the more basic inventory kind of diagnostic tools where, you might have a limited space in your warehouse. Are you optimizing that for the products that are actually selling? Or, is there a lot of inventory sitting there? From being a merchant in my past life, all the things that matter and keep you in a job as a merchant is, how much profit you're generating from that inventory turning. Those are really the only 2 things that matter. And so, approaching somebody's, say, Amazon FBA account and looking at their inventory positions or looking at their total working capital, that type of lens is super helpful. If you've never been a merchant, you haven't thought about it just in those simple terms.
It's usually, I'm out of cash. What do? I need more inventory.
Right. Right. But I've worked in an environment where we had finite shelf space, and your ability to make that finite.
God, you don't get another shelf. This is the building.
Yeah, exactly. And then in the digital environment, you have infinite shelf space. And so you have a different set of, probably inventory management rules, but they all follow the same basics, which are, we've got to be in stock as efficiently as possible to reduce that cost and still account for, the old analogy of, if you own a restaurant, you always want one person waiting at the door for the table, because then you've sold every table that you possibly could. The line gets too long and it probably dissuades people from coming, and the line's too short and you haven't, sold every table to maximize your revenue. So you want one person.
Great analogy. I love it. What I think
you asked about working capital, Ryan. I guess I would throw back the other way. Like, one of the things that I guess I'd ask an e-commerce sellers, they focused on startup. They focused on like, hey, I want to drive revenue. They might not be at a place where they've started to pivot toward, how efficiently can I run my business, or how much cash am I throwing off to think about it. And I guess the other is like, sometimes folks, they haven't thought about their exit. Like, what are you trying to get to? Are you trying to get to a cash flow model that looks great and has these kind of metrics? Are you trying to get to a particular revenue size? Are you trying to get to an engaged customer count? Are you just trying to get to sell? Like, what's your, you've been doing this for 2 years. You got your brand up and running. Congrats. It's awesome. Do you have an end game? Right. And I've heard mixed answers. Like, wow, I just haven't thought about it that way. Right. So I don't know how you've seen it, but
you guys are going to be episode 260 close to, and it's about 200 episodes of people going, I didn't know what I wanted. Name the industry, name the size of company. And I actually, on the podcast I just got done, we were talking about it. I'm like, it's people walking on sports fields, not knowing what the definition of a win looks like, which is just crazy. Are we playing soccer or football? I don't know. The guy just tackled me. I thought I was playing soccer. And it just, and it really comes down to that.
That was rugby.
Yeah, exactly. Yeah. And it's this understanding of enterprise value and net proceeds, and like, what are your options? And you guys have already, like, I've already gathered that how you're different from what I'd heard through, different anecdotal stories from what Thrasio or whatever other aggregator it was, where it was, show me your Amazon account, we'll give you a valuation, because they knew how to put it into the machine. It was like buying a product for them instead of buying a company. Where like, not, you guys are looking, I mean, what you just described, how you're assessing the risk of the company and the cash flow and what the potential is, which is a little bit different. And I think it's interesting as I've watched, I don't know of those 55 aggregators, Stefan, they're like, what the actual enterprise value purchasing power of all those aggregators could be. Because the way I was kind of like, I heard it, I'm like, I bet you it's like 5 or 10 billion. And are there even enough companies to even buy? So you're going to now have the multiple go from 2.5 average to above. And like, so I just watched these different kind of big moves happen. I just find it super intriguing, because someone's going to have to still make a return, right? So they still have to do the things that you guys are doing, which is buy real companies and make better.
Yeah. As I talked about, as one of the set of questions I would ask is, as different as I had the privilege and fortune of being talked to by different companies, is, I'm looking at your employees on LinkedIn, and I get that there's M&A, but I'm seeing an awful lot of Wall Street, whom at your company has, shipped packages out. Right. Who's talked on the phone with or answered Amazon customer service email, because these are the things that can get you hung up. Amazon's not a great training ground to learn e-commerce. It's not super forgiving, because they expect you to help elevate the customer experience on shopping on Amazon. Right. And so, you got to get a return, right? You
got to know what you're doing.
You got a timer on that, right? And by the way, it's very public transparent how they're going to leave a review on your product or a review on you. And so you do see this. So we certainly thought operators, not to say we don't need M&A people, and we are building our company, and we're looking for some great brand managers and some great data engineers and some great M&A people to join our team. If they love small business, they love growing business, and love operating. What I know in some of our Amazon stuff, and there is a thing we do think about in a 3 to 5 year time frame. Thrashio's at what, 110, 120 acquisitions at this point, right? I think distant second, after some rumor they're doing like 6 to 8 a month or something. But I think distant second is another one with maybe 30 acquisitions, right? And then there's a lot of folks in the 3 to 10 category, and they're accelerating or not. So maybe all up, there's been 500-ish brands, that have been acquired, right?
Isn't that crazy when you boil it down like that?
There's well over 10,000 brands just on Amazon in the US and Amazon brand registry that meet kind of size and interest criteria that Foundry would look at. So
there.
So that's why I'd say, like, we're not here to like, oh, we have to race and beat. It's like, no, we need to find a good fit, right? And help others find a good fit. If they're ready to sell, it may not be the right time. So can we serve them until it is? And then, how can we help create more brands? Right? Well, to your point, is there enough to buy? Well, there sure is today, right? But the rate of brand growth, like it is kind of a fresh table. So it's still a fresh table. And then I think that's just the Amazon shopping, or just the Amazon pond, if you will. We look forward to looking at all brands born online.
So even like people on Shopify, or because I know that. Okay, yeah, that's it. That was that. What's that?
Yeah, Clearbank, has I think Clearco now, whatever they're called. Michelle Romanoff and her team have done some great stuff, providing financing options, and they've certainly worked with founders and e-commerce companies, and talked with them. There's thousands on Shopify that have connected with customers and built mechanisms to connect with customers and deliver great products.
Well, this concept, what you just laid out, Stefan, is so important, because right before that you talked about like what is an exit and what do I even want, and this is the stark contrast where if someone is just hustling to sell, they don't have a brand and they just want to get 500 to a couple million and be done, and they don't really care what happens. That might be a certain select group of people, and don't build a brand, just go get your money, sell it, and be done, versus someone built the brand with their passion, their soul, and they care about their community and their customers. They're going to care about what happens to it afterwards. And these are the intangibles that people, hopefully listening to the podcast, have gathered over the years. Like, it's a big deal. I've watched deals fall apart because they figure out at the closing table that they're going to get their logo changed, and nope, literally $100 million. Nope, thank you. I created this logo in my basement. And so like, it was that was the deal killer. So thinking through that and how those intangibles correlate to the net proceeds over time or not. Because I've watched people like literally get what they want, but they took a little bit less money because it was right for them and their brands. And they just didn't know how to make that decision or what was in front of them.
Yeah. Sellers and the sellers that we've had a chance to meet, they've birthed these brands, or brands born online. So there's a lot of identity that can be tied up there. And who do you want to trust your brand to? And maybe some people are great, I'm good, like, take it. It's not a child, it's not a baby, it was a business, thank you, and I've got what I wanted out of it. And there's others like, no, I want to keep still looking, go like, I was the origin of that brand, and I want to stay being proud of it. And I may expect that it changes, because I would have changed it to delight more customers. But I want to trust the people that are going to be changing it also delight customers, and also understand e-commerce and have a deep experience in it, right? And so if those intangibles come into play, it's what's the right deal and who's the right partner.
So as we're rounding close to the end here, I got a couple of I'm curious questions on like what you guys see is like happening and the trends that are going on, just to kind of no particular order. Like, I've watched are certain brands getting into manufacturing. I've watched certain manufacturers try to get into online e-commerce brands, and to essentially get up in the vertical supply chain integration to get a bigger multiple. One guy was on my show recently, I've known him for years, manufacturer of epoxy, and built an Amazon brand and went poof, and his multiple went through the roof because it was manufacturing and e-commerce and influencer on Instagram. Like, really unique combo of everything. And so like with like you said, the fresh table, not a whole lot of, decades to go back off of, where do you see things going, and how does that impact what you like, the conversion of different industries or different, parts of the supply chain, and how that's going to impact what you guys do?
Yeah, I mean, I think near term, I think, even this year, if you believe what you've read, I think there's, 12 or so companies that, were largely debt financed that kind of went upside down when they had to comp against COVID months and a bunch of stuff. And so, I think at some point, there's a possibility that, that everything accelerates in terms of, I don't particularly love the term aggregation. If we use that term, there could be aggregation of aggregators. You could start finding that, some of these smaller, debt financed aggregators start to realize that, with the equity funding that others have, there could be some consolidation. And I think, what we've seen through most of the digital age is just that unnecessary layers in the supply chain tend to get over time. Somebody figures out how to cut those things out. And so to the extent that, manufacturers become, more prolific for creators, I think you see sense of that happening everywhere. It's just a matter of, you still at the end of the day have to have a solid business that's connected and working synergistically to accomplish your goals. Just by having a manufacturing plant doesn't solve that. It's that I have to be able to manufacture great products. I have to be able to promote those and acquire new customers. And then I have to take that customer feedback and I have to, create a flywheel back to how I'm manufacturing products and better and anticipating where customers want to be. And so that, I think, is what makes it so challenging to consolidate. It's not just hey, I need a manufacturing plant. It's like, no, I need the right manufacturing plant that helps optimize my business, right? And that's a more complex question.
I'm laughing, Kyle, because I can tell you packed and shipped boxes because it's making real things for real people that have real money, that have real margins, that make a real business profitable over time.
Right.
Right. Right.
That's exactly it.
But unfortunately, in today's ridiculous environment, that's not always the case. And the traditional founders can't spot that. I'm literally working with people right now where they're a couple different stories, and these are from different industries, different size companies, but I got a PE firm that's buying a company to then sell their entire portfolio by the end of this year. So it's multiple arbitrage on an insanely large company. And you're like, somewhere, somehow, someone's gonna have to continue selling shit to people that are happy. and then there's other people where like these private equity firms that are traditional manufacturers, they're like, well, we need to get into e-commerce. And I've got this one example in my head right now. It's a $15 million EBITDA PE firm. And they want to go buy these e-commerce companies. I mean, think about it, like a $2 million e-commerce to bolt on top of that for the story to sell the whole fund, right? It's nothing to do about, like you just said, making it work over time. It's just like, and it's so difficult if you don't understand this game. Like we go back to the sports analogy, you need to understand this to spot it. Because otherwise the story makes sense on face value, but most people don't know what's actually going on behind the scenes.
Yeah, I mean, just as Stefan said, there is no such thing as buying or holding. A business is a living entity. You're either continuing to grow, there's something happen every day, that function needs to continue, it needs to get better, it needs to be improved. And what are the processes to do that? And part of it may be, hey, look, there's a time and place to go buy something, there's a time and place to go build something, there's a time and place to, outsource. But ultimately connecting all those pieces in a way that makes the most sense for your business to run, ultimately only facilitates your connection to, am I connecting with customers and solving a problem for them? Because at the end of the day, if you're not, it doesn't matter how much you can manufacture.
Like you said, that's the PE, M&A, Wall Street. We're like financial engineering. My business partner, when he worked at a PE firm for like a hot second, he was like, yeah, they would have all these models of like, we buy the company and then the growth just 45-degree angle straight up. And he's just like, how about we not, like, that's not real life. And it's so interesting, man. It's so fun to hear people with common sense, but then back it up with discipline and execution.
Yeah,
it goes back. I worked on a farm when I was 12 for a long time, and then 14 worked in a bike shop, which is a small business, and we opened 2 additional stores. And at the end of the day, you're like, you see how the money works when you and where it goes, because you have the because of size, you can see it very easily, and then as you grow, your business grows, it may be harder to see, but having that background, you can extrapolate pretty quickly.
Someone paid for the box, we got to send it out.
Margin, makes a difference.
I love the farming analogy, because Stefan and I have talked about this before. My grandfather had a farm too, and at the end of the day, you may start at 5:30 in the morning and you're not done until the hay is in the barn. We can sit and talk about how the hay needs to get in the barn. We can sit and talk about how valuable the hay is. We can talk about where we're going to store it. But at the end of the day, like, somebody's got to cut it. Somebody's got to, put it in bales, and somebody's got to get those bales moving. Yeah, on the bale wagon, and we got to get it off, and we got to get it stored. So
you don't get the multiple expansion from sitting on the porch having a cocktail talking about it like that. Come on.
I've never heard about multiple expansion on bales of hay, but
I interviewed this accountant once, and he goes, I was like, tell me about your work habit. He's like, I grew up on a dairy farm. You milk the cows in the morning and the afternoon, no matter what. It's just like, all right. All right, well, I've taken us down a random rabbit hole, but we'll wrap up for you guys. I really appreciate it. This has been a lot of fun. I have a question that I ask everybody at the end of the show about the word intentional, because that we renamed the podcast and our framework that a couple years ago. And I love it because it means so much. And I want to hear, if you guys were to talk to an owner or go back to yourself and, before you joined Amazon, what would you say to yourself of what the word intentional means? Kyle, you first.
To me, I always think about what I'm trying to accomplish and making sure that my actions every day are, I know you're not supposed to the definition of a word and defining it.
I'll deal with it. It's all good.
Yeah. No, it's working back from what I'm trying to accomplish, and how can I be intentional every day about trying to, make decisions that support getting to that end point. I've always tended to, in terms of people, what's somebody's 5-year plan? And I've always thought that question is hard to answer for me, because my focus, how can I be better tomorrow than I was today? That's all I'm focused on. Wherever I'm at 5 or 10 years will be is where I'm supposed to be, in a better place, right? I'm going to focus on being intentional with my actions every single day to try and be a little bit better tomorrow. And I think that only happens if where is my ultimate end goal? And, I think that forces intentional actions.
I love it. How about you, Stefan?
I don't know. It's baseball season. I should be watching the Cubs game right now, and I'm watching my kids play baseball and other sports. As they're kind of growing through it, and some of the intentional things is I guess the intentionality there. Part of why I love baseball is because it's a game, and you have to think through, like, on any given play, a whole bunch of different stuff can happen, right? And so there's understanding the connections between what can happen, and then having some principles and how you make decisions. To connect, to help the connections. It's a simplifier, right? Whether tenants or other principles you use to make decisions. So, similar to what Kyle said, I can't predict the future. I don't know where it's going to go, but I can, go, here's some objectives that I have. What are my decision principles? One of which would be like, hey, I have an open hand on those objectives, and something better may come. Mm-hmm. But if I know how I make my decisions, we're good. So,
that's fantastic.
If I have to watch a different team than the Cubs, that may be okay, because baseball is still better than other sports I might want to watch. So, I can have that open hand. But, having some objectives, having some decision criteria, combined together to give you some, what I think is intentionality.
I love it, guys. This has been an absolute blast. What's the best way for the listeners to get in touch with you, find you, and reach out for more information?
Best way to get in touch with us is, we're both very present on LinkedIn. FoundryBrands.com is our company website for ourselves and our partners in our enterprise. And that has a contact form that'll get it to us.
Thanks, guys, for coming on the show.
2 separate contact forms if you're interested in there, or if you're interested in having a conversation to figure out what your business is worth. Either one, super valuable uses of our time. So encourage everybody to come drop us a note.